talking about Ishmohit, who's joining us today. He is also very popular among the millennials and Gen Z investors, and he's joining us today, Ishmohit Arora. He also is founder teacher at Soic, which is School of Intrinsic Compounding. Ishmohit, afternoon. Thank you so much for your time. Before we talk about markets, I gather that you've been touring across the country, some very interesting locales, including Goa, and have been meeting investors across the country. Before we talk about market, give me a pulse of how's the sentiment on street among investors, young investors, HNI investors. Is it getting frothier in terms of behavioral finance? Are there so much excitement on street, or is there caution even among them?
Thank you for the warm introduction, Ajaya. So the interesting thing is everyone is a bit skeptical about the returns that they have seen in the last 3 to 6 months. And when you speak to a lot of other investors, then everyone is a bit skeptical. Even we are also a bit skeptical. But the interesting thing is whenever we think that we are a bit skeptical, we always end up finding some new interesting opportunities. So broadly, the last 3 to 6 months, the entire rally in last 1 year is actually led by earnings growth. It is not just price growth. So when we look at PE ratio, it's like price and earnings. But majority of the rally has been led by earnings. Some of the sectors, some of the businesses have grown their earnings at 40 to 50%. And that makes it very, very interesting in the entire structure of the markets. So speaking to other investors, still there is a bit of skepticism that the entire thing is going to collapse. And this is how the bull markets are born. Bull markets are born on the basis of skepticism at the end of the day.
Ishmohit, let's start by let's also talk about the mid-cap, small-cap end of the market. Today we had a big FII, calling it slightly frothy. I was looking at the data. Too much flows seem to be getting concentrated in small-cap, mid-cap. Two big funds have stopped lump sum, Tata and Nippon, and only advocating SIPs. You analyze small cap, mid cap very closely. What is your approach right now?
So in the current small and mid cap space, so if you look at Nifty small mid cap 400 index, so I think the current PE ratio is somewhere close to 24 to 25 times. But the very interesting thing is, Ajaya, like last 3 years, if you just broadly look at Nifty, the earnings CAGR has been 23%. And do you know, in Q1 FY24, the earnings in Nifty has grown at 32% YOY. So broadly, it's backed by earnings. It's not just price appreciation. Yeah, yes, there might come a point in the future where the price goes much ahead than earnings. But because of input cost softening and because of capex spends in a lot of other sectors, the earnings have grown really, really fast. So I think there is still some juice to go because there are still few sectors which look very like reasonably valued. Maybe not that cheap like 6 to 7 months ago, but some of them look reasonably valued. But we are trying to stay away from companies where cash flows are negative or they're at 80p, 90p, 100p. Because actually, if you go back and do case studies, then you'll find that whenever a business, like just because we are emphasizing on PE ratio, on normalized earnings crosses 50 times earnings, then it becomes very, very difficult for the earnings to keep continuing. And that is where the chances of doing mistakes also grow. So over that end of the market, there could be some froth that is being created. But bottoms up, I'm still finding a lot of different opportunities which are there.
And select pharma. Pharma still has started moving up because the commentary from sector leaders were good and there is buying interest. But nobody wants to touch chemicals with a barge pole. But today, if you see, most of the chemical stocks are gaining in trade. And, SRF, be it UPL, weak commentary, but a hope on the second half, but uncertainty. You see scope in select chemicals. Talk to us about the thinking behind this contra call.
So just before I give the thinking, so I'll just give a disclaimer as well that we are a SEBI registered research analyst and nothing will be a buy or sell recommendation in this interview. So our interview is purely for educational purpose. So in select few chemicals bottoms up, the multiples have really corrected a lot. And suppose something like this is a mixture of chemical and an API business, something like an Aarti Pharma Labs, just as an example where they have 50% market share in xanthine and caffeine, and also remaining business is 50% APIs. So the margin is somewhere close to 18 to 20%. And over there, they're doing, I think, 350 crores of capex. So that bit of pockets look interesting. Within the chemicals place, the fluorination guys have been doing very, very well. But over there as well, there is some destocking cycle that is happening. But again, uncertainty leads to reasonable valuations, because if there was no uncertainty, so you won't basically find businesses like Gujarat Fluorochemicals, which are into fluoropolymers, or businesses like SRF, which have actually grown their chemical exports at almost their EBIT in chemical business has become 10x in last 5 years. There could be a 2-3 quarter slowdown which happens over there, but within chemical space as well, I will only look for those companies where there's some element of pricing power, where they can sustain their margins. Broadly, companies which cannot sustain their margins, suppose in a camphor space as an example, over there, maybe the cycle is gone for the next 3 to 4 years, because a lot of players came in and expanded at the wrong time, because just at the peak of the cycle, and due to which the pricing of a lot of those chemicals have just corrected a lot. I think one of the chemicals we were checking, it is at a 7 to 8 year low in terms of pricing. So we are trying to stay away from commodity chemicals. We are trying to look for those companies where the margins are a bit more sustainable. Something like your ultramarine pigments is also something that we are studying right now, just as a disclaimer, where the margins look very sustainable. And again, they have done a lot of expansion. So those type of opportunity set that we are finding to be interesting within the chemical landscape.
That there's a lot of interest in power sector. Well, and there is no doubt about it. The kind of reforms the government is actually taking to rejuvenate the entire sector. NTPC is at a 14-year high. REC, PFC are gaining. Even the renewable space, Suzlon, Inoxes of the world are gaining. But you like that end of the power value chain, which nobody talks about, and that is storage, batteries. If you can take examples, even better. And why do you like batteries in the entire power value chain, with the disclaimer that this is just for example?
So again, what has happened, Ajaya, within the power landscape is that we are going through a grid transformation capex right now. So as solar and wind comes in, so what happens is that these sources of power are very intermittent. So sometimes sun will come, sometimes wind will come, sometimes it won't be there. So you also have to invest in storage of power, and also you need to really invest in grid transformation. So this throws up opportunities. Like one of the easiest ways to look at this sector and to play this sector is through cables and wires space, because the largest players have 10 to 15% of the market share in that landscape. Something like a Polycab, something like a KEI, something like APAR, who's also exporting from here, but APAR has had a huge run up. But something like a Polycab, KEI, even though they have had a run up, but still they are growing their volumes at 15 to 17%. Those type of spaces, then it ends up becoming a very interesting proxy to the entire power thing, because suppose if installation of wind and solar also happens, so actually the cable or the wires that you need, the amount of it ends up increasing versus the traditional capex in power. So that area looks interesting. Then secondly, if because the grid is transforming and these sources will be intermittent in nature, then you also need to invest in energy storage capacities. So energy storage capacities, I think world over, we have seen that how lithium ion batteries have taken over. But again, first I'll just explain the risk. This is a very new technology. And there could be a sodium ion batteries also which come in. But I think one of the listed companies that is Exide in that landscape has actually done capex and put up the plant for lithium ion, which makes it look very, very interesting, because their plant goes live in FY24. So they're actually exposed to auto as well, telecom as well, and also to basically power sector as well. So this energy storage can be a very interesting trend going forward. So whenever we look at sectors, we always think about proxies, how we can go and play the proxies, because looking at Gencos or Discoms, it becomes very, very difficult, because these are PSU businesses and something or the other can happen when it comes to black swan events. So we are always thinking about what to look for as a proxy trend to such businesses.
Ishmohit, I also see microfinance being on your radar. In fact, there's a note by ICRA today, and past few, in fact, even the entire microfinance earnings, was also very good. How are you playing the microfinance bit? There are, some names like Poonawalla, which have got a microfinance piece. Then there are isolation microfinance companies also doing very well. What are the names on your radar? And people are also saying it's getting overheated. Do you think this cycle has more legs, the microfinance cycle?
So again, Ajay, like as always with every sector, I'll start with risk first, is that microfinance is a purely deeply cyclical sector. So in a good cycle, microfinance companies will always make 30 to 35% return on equity. And when there is a bad cycle, these companies will go under losses. So you'll see that these businesses will have very high credit cost in a bad cycle. So with that caveat, you need to understand that we are looking at a deeply cyclical sector. But because the asset quality currently is very, very like pristine, like so a lot of these microfinanciers net NPA has fallen to below 0.4 to 0.3 percentage, and they're growing their loan books at 25 to 30%. So this sector will always have 2-3 years of good cycle followed by 2 years of bad cycle. So a lot of bottoms up businesses like something like microfinance space, like within small finance banks, there is a Ujjivan basically that is there, which has had a whole cycle of cleanup because the earlier management left and there were a lot of KMP resignation. But again, now the business is doing well because the old like management came in and now they've done the entire cleanup. They are doing 30% ROE. And in Ujjivan Financial Services versus SFE, there is also a 10 to 15% arbitrage, which is also there. Then there are like very pessimistic lenders. I call them pessimistic because that is something that you always look for in lenders. Is something like your it's a very like it's in a NBFC space only. That company has done phenomenally well over the years. That is in Arman Finance in that landscape. But again, we have to realize is this is a deeply cyclical sector. So any investor who's looking at such sectors right now, you need to know you're looking at a deeply cyclical business, and whenever the cycle goes for a toss, it's very normal for these businesses to like crash 40 to 50% or start reporting losses. So you need to understand this risk if you're looking at this sector today.
Right. All right, Ishmohit, we'll let you go on that one. Thanks so much for joining us. It is good chatting with you on a host of areas in the market.